Hi everyone, it's Andy here from Abacus Accountancy. If you're running your own limited company, you've probably wondered whether it's worth putting a car through the business. Today, we're going to break it all down, the costs, the tax implications, the pros and cons, and help you figure out whether it's a smart move for your business. So, should you run a company car through your limited company? Let's start with the basics. Not all cars are treated equally. Petrol and diesel cars, especially those with high emissions, are generally the least tax efficient to run through your company. Why? Because of something called benefit in kind tax, which we're going to cover in this video. Hybrid cars are slightly better, but the big winner right now is electric vehicles. EVs have a much lower benefit in kind rate, currently just 2%, which means a much smaller tax bill for you personally if you're going to use it as a company car. Now, company cars can be used purely for business, but this is incredibly rare and very hard to justify. 99% of company cars are used for both business and personal use, and HMRC are well aware of this. So here's the key. If you, as a director or an employee, use your car for personal journeys, even just popping to the shops, then it's classed as a benefit in kind, and HMRC wants a slice of the pie. If the company vehicle is not a car, for example a van or a truck, then that is different. It's quite likely that will be 100% for business use, like a van used for deliveries, for example. And in that case, there wouldn't be a benefit in kind tax. So let's explore this benefit in kind a bit further. Benefit in kind, or BIC, is a personal tax that you pay when your company gives you a perk, for example a car that you can use privately. The amount of benefit in kind tax depends on two things. Firstly, the list price of the car when new, not the price you paid for it. The list price is a published figure that you'll have to find out for your particular vehicle, make and model. Secondly, the CO2 emissions. Again, this is a published figure. The higher the emissions, the higher the benefit in kind percentage, and therefore the higher your tax bill. So let's look at an example. A petrol car with a high emissions figure might attract a 30 to 40% benefit in kind rate. An electric car with zero emissions has a benefit in kind rate currently of just 2%. That percentage is applied to the list price, and then you pay tax on that figure at your personal tax rate, which is going to be 20%, 40% or potentially 45%. Depending on your income levels. So I'm going to give you an example of a couple of different types of vehicle. A vehicle with a list price of $50,000 that's a petrol or diesel car with quite high emissions could actually equate to a benefit of around £15,000 a year, and you would be taxed at either 20% of that, 40% of that or 45% of that. That's quite a lot of money. If we looked at the same car, £50,000 list price that was purely electric, then actually the benefit there is around £1,000. So you'd pay tax at 20% of that, 40% or 45%. The difference is staggering when you look at the figures like that. Next up, how you get the car also matters too. You've got three main choices. Firstly, outright purchase. So the company buys the car outright. This allows you to claim capital allowances, which for an electric car are up to 100% in the first year. So that's quite tax efficient. Running costs are also deductible, but remember, you will pay benefit in kind tax if there's private use. The second option, hire purchase. This is treated in a similar way to an outright purchase in terms of tax, so you can still get the capital allowances. But it's a bit like a loan, so you're paying a monthly amount to the finance company, and at the end of the agreement, the expectation is you will own the vehicle. The finance and interest elements of this option can also be claimed as an expense. The third option, and often the most popular, simple way of putting a car through a business, is a lease, or often referred to as business contract hire. You don't own the car, you effectively rent it from the leasing company, and you can't claim capital allowances. But the rental payments or the lease payments are fully deductible. There's some restrictions for high emissions car, but generally you can claim the tax back on those payments. You might also be able to claim 50% of the VAT back on the lease. This is different to an outright purchase where if the car's going to be used privately, you would not be able to claim the VAT back. So there's some intricacies there which would need to be explored on a case-by-case basis, and that's where we can help as your accountants. So as you can see, there's some pros and cons of running a company car through your business. You've got things like the costs, the fuel, the insurance, the maintenance. They can all be paid by the company. We've talked about electric vehicles and how they have excellent tax treatment at the moment. So low benefit in kind and 100% capital allowances available on purchases. It also is a great way to help the company allocate its profits, because by buying a vehicle or leasing a vehicle as a business expense, you're going to be reducing your corporation tax. Some of the disadvantages we've talked about are the benefit in kind tax and how this is really quite varied depending on the type of vehicle. It can be quite low for EVs and it can be really quite high for some of the petrol and diesel models out there. There's also some admin burden that comes with providing benefits to staff or directors, something called the P11D, which is a benefits and expenses form that the company will have to produce each year to tell HMRC about the benefits. The final point is that you personally will pay tax on having this benefit or having this perk. Even if the company is paying for the car and paying for the running costs of the car, you will have a personal tax implication. And we've talked about how that depends on the benefit in kind rate and also your own personal tax rate. So what's the alternatives to a company car? Well, sometimes it's more tax efficient to keep the car privately and charge mileage rates to your company at the HMRC approved rates, which at the moment are 45p per mile for the first 10,000 miles, 25p per mile thereafter. This means you own the car privately, you're responsible for the costs and the maintenance, but the company will pay you those rates for all of the business miles that you do. So, should you run a company car through your limited company? Well, it depends. If you think that an electric vehicle might work for you, and you know that it's going to be a mix of business and personal use, then that could be a great move. But for high emission petrol or diesel cars, really, I would find it hard to justify that as a business decision. There are also a lot of mixed use vehicles that can be used as a van or a car or for various purposes. Now what about these? This is a whole grey area. We've decided to publish a separate video on our YouTube channel to explain the tax treatment of these borderline vehicles. If you subscribe to the channel, you'll be able to see all of our content and catch the latest videos as soon as they come out. So if you're unsure what's right for your situation, we need to have a chat. Get in touch and we'll help you crunch the numbers and decide what the best solution for you and your business is. Thanks for watching. See you next time.